You could grow your wealth with this DIY framework. It's called the Lazy Genius Framework. It requires very minimal effort, and you can probably beat the market and still keep things very simple. This is backed by real data, which I'll be revealing here, one that most people overlook. So stay with me till the end, and I will share a tip to supercharge this plan. So if you like investing strategies that are creative and action oriented, please consider liking this video. It keeps me motivated to share more. So let's see how to choose the right indices and craft a winning portfolio. Most DIY investors prefer index funds for wealth creation due to their simplicity and low cost. However, for those of you seeking higher returns, better risk adjusted performance, a more active approach can be beneficial. So many investors assume index investing means Nifty 50, but that's only half the picture. So today I will introduce other broad market indices and options to invest in, and also share some steps on how to select what index at what time. Let's look at this historical data. In 2016, small cap index was the worst performer with just 1.4% return. Suppose you had invested in this index end of that year. In the next year, that is 2017, it delivered the highest return at 58%. In 2017, the worst performing index was Nifty 50 at 30%. By the end of next year, 18, it emerged the best performing index. Modest but positive 4.6% gain. All other indices were negative. 2018 small cap was the worst performer at minus 26%. If you invested in it, by 20 it became the best performing index compared to other indices, delivering 26% return, and it continued to be the best performing index in 2021 also. Similarly, in 2019, small caps underperformed at minus 7.3, only to rebound to be the top performer the next year. It continued, that is 2020 and 21. However, this trend that invest in the worst performing index of the previous year and you will be at the top as a top performer the next year, this is not foolproof. In 2020, Next 50 was the worst performer at 15.9, but in 21 it did not top the charts. While small cap led with 63%, Next 50 still delivered a solid 31%, outperforming Nifty 50, which was at 25%. In 2021, Nifty 50 was the worst performer at 25.6. By next year, it became the best performer, delivering a positive 5%. In 2022, small cap was the worst at minus 2.6, but it rebounded in 23 with a stellar 49%, the highest amongst all indices. Finally, in 23, the worst performing index was Nifty 50 at 21% return. While next year it delivered 10%, it wasn't the best. Nifty Next 50 claimed the top spot with 28%. So this data reveals a certain pattern, and that pattern gives us an idea on making investments in these indices, especially for those willing to explore beyond the Nifty 50. So let us analyze the insights from this chart that we just studied. Historically, indices that underperform in 1 year tend to bounce back strongly in the next 1 or 2 years. This reflects a mean reversion tendency, where the underperforming indices return to the mean or outperform after being in the oversold territory. There are exceptions to these rules that we saw, like in 2020 and in 2023, they break this pattern. The worst performer, that is Nifty Next 50 or Nifty 50, does not always rebound to be the best next year. Despite this, the worst performing index often delivers better returns than the previous year, making it a reasonable contrarian bet that you can take. Third is about investment horizon. While short-term rebounds are very visible, In a 2-year horizon, it often improves the likelihood of benefiting from this mean reversion. Example you saw was small cap index in 2018. It was only in 2020 that it became the best performing. The fourth insight is about diversification. Instead of betting solely on the worst performing index, a diversified allocation of underperformers and a broader index may smoothen the return journey and also reduce the risk. Fifth is about selling opportunity. Indices with huge outperformance in a year often see moderated returns or even an underperformance in the subsequent year, helping you make some decisions around selling or rebalancing so as to lock the gain. So you can use this framework for selling or switching, for example, small cap funds that later go through huge corrections. So let us create a formula or a strategy for DIY investors. Let's call it the contrarian allocation strategy. Each year, you allocate 40 to 50% of your new investment to the worst performing index of that year based on past performance. You then go on and hold it for 1 year or a 2-year horizon to maximize the chances of benefiting from a rebound. And you allocate the balance 50 to 60% to a very well diversified frontline index or an active fund portfolio to take care of the exceptions. So key takeaways: when investing in index, consider allocating a portion of your money to the worst performing index of the previous year based on past performance. Historically, this approach often rewards you within the next 1 or 2 years, though diversification is very key here to manage the risk. Second takeaway is to acknowledge the exceptions that we saw. While this strategy might work most of the time, there are exceptions. The next is the behavioral aspect. This strategy requires discipline and patience because it goes against the natural tendency to avoid what is currently poorly performing. But why does it work? Indices with poor performance, they often include stocks that are oversold, and these stocks often rebound when the market cycles shift. Leading us to another very important topic: how do you build your portfolio with active funds? If you're willing to invest more time in research and aim to outperform the broad market indices, when it comes to active investing, the debate is which mutual fund to follow, quality investing or value. Here is the performance of quality fund represented by the index versus value over the years. Here is what stands out. No consistent winner. Some years quality triumphs. Over years, value takes leads. Reversals are common. If you had constructed a portfolio of funds that follow growth investing, after seeing success of 3 years, 18 to 20, your portfolio would have severely underperformed in 21 to 23, when value style of mutual funds did exceedingly well. It is important to have a well-balanced portfolio. Otherwise, you'll have all your funds doing very well at one time and doing badly altogether at other times. There are some fund managers who try to be flexible and accommodate these flexible approaches in their funds, moving dynamically between these styles as market shifts. Over the very long term, since inception, quality has had an edge. Quality delivered 18.8 CAGR, marginally better than value 17%. Watch this video to know how to use rolling return and quartile ranking along with 4 other key matrices to select active funds effectively. As a DIY investor, you might wonder, how much do you need for retiring? How long will your corpus last? To help you with these answers, I recommend watching these 2 videos. DIY investing is a very vast topic with endless possibilities to learn. I have shared a few key ideas in these videos, and you can explore more in the dedicated DIY playlist. So index funds are excellent for passive investing, but comes with a hidden risk. Once a company enters an index, money flows into it based on its own weight, not on the ongoing fundamentals. This means larger companies get more allocation even if they are overvalued. While this works in a rising market, it can lead to sharp declines during downturn as funds sell this indiscriminately. Balancing index funds with an active strategy can help you manage and navigate market risks. In conclusion, summarizing the contrarian allocation strategy, the three-step contrarian strategy. First, spot the underdog, allocate 40 to 50% to the underperforming index fund. Second, balance your bets, allocate 50 to 60% to broader market funds or active funds for stability and alpha generation. Third, stay the course, hold it for 1 to 2 years for an effective rebound. There's an emotional aspect to contrarian investing. It's tough to buy what others are selling, but that's where the magic happens. For more such insightful content, please hit the like button, share it with your friends, and subscribe to this channel.